Right, jet setters, or jet setter. These I actually do primarily for my own benefit. I was chatting to some guy the other day about it. I'm doing these videos, but they're actually mainly for me because I find it very handy, helpful to verbalise what's going on in my head. It actually helps me do better in the markets. Anyway, I haven't really done much because things have kind of been going according to what I've kind of been expecting and talking about. So I haven't really changed a lot of what I've had on. You know, the macro picture, commodities turning, curves inverting, stock markets kind of done their hard work in terms of the down leg. It's all kind of, that's been the story, right? So this is the S&P going back, it's weekly, and a lot of the equity markets, they've just done this same thing, which I've talked about before. We're really, that is the norm for the last 24 years or something, right? These are the outliers. End of the GFC and obviously COVID. But really, it's actually like, let's face it, 95% or more, that's the band, right? That's like the 2%, and this is the other 2%, really. So I remember like a couple of months ago, I don't know how long ago was it, I kind of said how it had kind of touched this line. I said, look, I think it's kind of done the hard work. I'm not sure if it's going to go any lower. For a long time I had this target in here, so there's a little gap in here, and it's come back and it kind of filled that, did a bit of hard work, hit that middle line of that long-term trend, and also hit this little band in here, just the top of it, which has been another target I've had in mind. This gap here, filling that, is more substantial than that gap. That had a bit of a backwards and forwards in it. This is like the breakout post the 2020 election, vaccine news, all that kind of thing. So this one was bugging me for a long time, and it was filled. That was a target. This one, I'm a little bit surprised from us that it didn't have a deeper stab at it. You can see that it had a lot of resistance around about 3,500, boom, boom, and then when it cracked, it went straight through. Not as exaggerated as that, right? But it still went through, and when it came back to test it here, right, it didn't go through. Same as here, it came back to test the top and it couldn't close through it. There's a lot of this other stuff, it's kind of overlapping, right? Gap there, not as substantial, but I'm still surprised that it hasn't really gone down there, 3,500. Never quite had the clean out event, but you can see it's a pretty radical, pretty hefty turnaround from there. And it's no doubt starting to hit some fibos or getting close. Oh yeah, like a 38. There we go. Yeah, so it's just depending on how you measure it. The high, that low's there, it's just on 38 retracement. That 4,200 level in here, that will be a key target, which is where it closed here, and it's just at the top of this band. That high there, that's what I think I suspect it will hit that and turn around. Just because I don't think the mood has really changed substantially enough, famous last words, but also it should have a pause because on the 4 hourly it's massively overbought, right? For me, looking at the 4 hourlies, in terms of tactical trading, for want of a better word, when it breaks that 4 hourly, like that's quite substantial. Having said that, the break of the pattern here is quite kind of powerful, where it has done three things that I look for like quite a lot, where there's been a sudden move, like in one direction, where it then played a game essentially past the parcel, right? And then when it breaks through the neckline, it's quite a sudden move. I've got that on a few other charts as well. So it's done that. the reverse to what we've seen in a lot of, for example, commodity markets, shitcoin, bonds, all that kind of thing. So the way it kind of like went through, had a test, and then went off, that is quite a powerful thing. So, and the RSIs mean a little bit less when it's breaking those things. So it could go, as high as there, I'd say, around about there, 4,400. That'd be a pretty punchy move. I expect that, I kind of think it makes more sense for it to consolidate in this band here. And the roughies, like from say 3,600 to 3,009, that's like roughly 300 points, like, which is that kind of range in there. And from 3,900 to 4,200, that's 300 points as well. So that's what happens in a lot of these patterns when it kind of breaks out. It creates has a bit of a range. Then when it breaks out, it goes to from there, that to that, like a 1-for-1 kind of move. And that's like say 3,640 to 3,900. That's 3,940. That's 300 points. And you add like 300 points on that, and you get like 4,240, and that's kind of what's the top of the range there, right? 4,200. So really, I'm looking for it to kind of pause there. Could well be wrong. That's the S&P. As I said, I do like, because when I haven't really been looking at the markets that closely, I do like looking at them in these stupid area charts. You don't see them used very often, but they kind of work for me. Like the Russell. Let's have a look at it quickly. Where are you, Mr. Russell? Same thing. You can see that's the big channel, like the outliers there and just up here, but 90-something% of the work is in here. This one did that same pattern I was talking about that we just saw on a smaller scale in the S&P. Big directional move up, past the parcel. Then when it breaks down pretty quickly, has a bit of a reversal and then a whooshka. That's why I'm a little bit wary of the S&P, the way in which you could take off, because it's that same pattern but just in reverse, in smaller time scale. The Dow, it's all the same stuff. I mean, it's all equity risk, so you expect it to do the same thing, right? Again, when you look at the lines, we haven't had the outlier event like COVID or the GFC, so I don't expect it to go down there without a further trigger, which we haven't seen yet. As I said, the trigger that I'm looking for is maybe a collapse in Bitcoin or maybe some sovereign defaults. They could be it, but I don't think we're going to see the triggers that are going to be as substantial as these ones that people will talk about for the next 20 years again, right? So again, the equity markets, they've done their hard work, and I think they're going to be just a little bit range bound, but bullish actually. 50% retracement that it's kind of come back on. Similar thing to the S&P where it had this gap in there that it filled. There's this smaller gap in here, that it just came to the top of that. So similar technical action, coming up to like a key level there, like 33,000. That's the Dow. The Nasdaq. I mean, the Nasdaq is very similar, a little bit more exaggerated, in that it's the valuations were more ridiculous than the Nasdaq. That's really where the stupid end was. So it made sense for it to come back closer to that line, not obviously to it. And it's again at a key level, like in here. I guess it's that a little bit higher, right? Yeah, maybe it is a little bit lower, maybe in there. I mean, I guess that whole band in there is going to be interesting for the Nasdaq as far as where it's going to go. And that will probably be the test around about 13,000. I had a feeling it was going to go like kind of lower down here. As I said, the markets, they didn't extend as low as I thought, but I'm basically that's what the entire market for, right? Because a lot of cash was on the sidelines, people had a bearish view, and that just means the thing kind of rallies. The ASX Australian market, which is what I've got most of my money in, just because I'm Australian. Same thing, right? All the same bands. This has come back to another very key level, and you can see there's so much chop around here, sideways action, far more than the US, right? And it's come back to the bottom of that range. Let me just have a look at the range here. That's like 630 points. Yeah, it didn't quite come down, did it? 630 points. Still a bit on the narrow, ignore that outline. 520 points, really that size of that range. Let go through here. Yeah, pretty much did its work. I do get the feeling that the market's, like an Australian market, it's going to hit these levels and turn and just have a bit of a sideways chop, I think. But I said it's not a high conviction. The only high conviction on the markets at the moment, the equity markets, is I think they've all done their hard work to the downside, and they're neutral to positive rather than negative. Now, commodities, on the other hand, the commodities have been turning, and I think they've got a lot more to go. So this is gold. This is something I've been short on and off for a while, but this is where it's been doing that same pattern that I've been talking about with other markets. Big move up, sideways movement, generally descending highs against a neckline, and then when it breaks, it is really sudden move down. You can see in this one, this is back in 2011, heavily overbought here, lower high, overbought close to it, but not as much. And it's the same action here, really. It's not as exaggerated, right? But it's still there. Move up, move sideways with some lower highs. We can see like an overbought signal there on the weeklies. Not as much overbought on the second and the lower high. And gold, I'm looking for, if it breaks this neckline, which it had a reasonable go at, then the risk is down. I've seen this pattern. You see this pattern like a lot. To me, it's I guess the one of the reliable indicators that I look for, and that's why I'm short gold. Somewhere where it's kind of worked for me more recently. So gold, I'm short. I'm just waiting for that to happen. Copper, I've been short copper, and I shorted it around about like 395. Well, it's just under here, right? When it broke that, and again the same pattern. Big sharp move up, right? Past the parcel. So basically this is everyone's running the party saying this is good. Then it kind of the party reaches its limit, and people are leaving, people are still coming, people are cashing in, people are going, oh, it's got further to go, but it is the past the parcel routine. And then when everyone says, oh, actually no, look, I think we're done here, it's a very sudden and rushed exit to the doors. So I do think copper's got further to go. I'm still short on that one. Another one there I've been short is coffee, because I was looking at a whole lot of commodities that have been doing this, and was looking at ones that hadn't quite cracked yet. Because a lot of the ones like wheat, that's kind of broken down, lead, tin, zinc, coal, all these things. And I looked at coffee and I thought, now this is an interesting one, because it's done a bit of the same thing. Big move up, bit of past the parcel with some lower highs, and if it breaks through, then it's going to break. So I shorted around about 220. It had a good breakdown, a retest. If it does what the Russell did, for example, it's really going down. When you look at coffee like on a longer basis, I just can't. Hope lives eternal, right? But coffee is one of those commodities that reverses very, very quickly after these spikes. And you look at these ones, big overbought like on a monthly, you know, and it's had a big spike. You know, they are these big spikes, and they're all in this range, right? And that's what we're seeing. Look at that, you know. And you know, when they reverse, you know, pretty quickly. There's obviously climate things, you know, related to coffee. Climate, I'm not talking about climate change, but you know, just the situation in Brazil with the weather, right? But it is one of those assets when it spikes, it can have some pretty big and sudden reversals. And so I'm looking for this one, and this one's actually lasted longer than some of the big ones. That one was a little bit longer, but when it reverses, it could really fill in the gap. And you look at some of these previous ones, like you know, that one, which that gap was filled. Again, this one, you know, it really, the market's just really come back to where they've broken out from. That one, that was a big, massive spike, big reversal. I mean, it just happens time and time again, right? This one up, bit of a retest, boom. So, and you know, it kind of happens the other way, right? Where you get these moves down and it, you know, shoots back up as well. But that's what I've got on in coffee. So I'm short copper, coffee, and gold. And oil, I've actually been short as well. Where's my little oil chart? Yes, I look at oil. Oil's a bit of a tricky one to short because the way the futures roll, and it gets stuffed on the rolls, which can be quite unpleasant. But oil's an interesting juncture. This is WTI, ka-ching, ka-ching, ka-ching. But also we do have, and it's nowhere near as exaggerated as the other ones, right? But we've had like a move up, right? We've had like a pass the parcel, okay? We've got like a neckline along here, and if it breaks, then it's going down a lot, right? To me, the significant thing is that it didn't break that high there. We've seen weakening momentum here, weakening RSI, if it gets in there. We've got a firm neckline in there, and if it goes, it'll not only break that neckline, but all these people who came to the party will go, oh shit, I'm out here. And the natural place for it to come back to is somewhere in there. I mean, that's first stop, like, you know, $84, $10, that's nothing in the scheme of things. For it to come back to, like, you know, the 60s, something like that, that would make far more sense. I don't know where the Fibos are on that. I don't think they make much come into play really with oil. You know, maybe 60%, 50, 38. Anyway, so that's oil. So that's commodities and equities. Rates is the interesting one. So I've squared up my rates like a while ago, and just had some curve positions on, and generally steepness in a few different ways. So the 10 years, that really hit the target. I'd been short the 10 years, but squared them up a while back. That hit that target. This is like a weekly. A few weeks ago. So that hit that target, which was the 1.6 of that move, and took it to that previous high there. These 10-year bonds are looking very, very susceptible to, again, that same old pattern, right? Big move up where there's not a lot of retracement, passing the parcel, right? This one's not as solid, right, because that is higher than that, right? Some people would say, well, that's like a head and shoulders, right? Could be right. But then when it breaks that neckline, which it is doing at the moment, it's coming down. And to me, I am wary of the curve inverting rapidly and significantly, because these 10 years are looking very weak, far weaker than the 2 years. And these things could go from, like, you know, 270 to the figure, at 70 points, very quickly, far more quickly than this, right? And that would invert US 2s tends to close to 100 points, like 90 points. I think that's very much on the cards. I'm wary of that. I'll show you the 2s in a minute, but the 10s look far more weaker than the 2s. And I guess what I'm seeing on a macro sense is, inflation is going away because the commodities are rolling off, right? So there's that. It's also coming off. Demand is coming off because US has been recession, and and in Australia, housing mortgage holders are starting to see the pain, and that further to come. So I do think that inflation is rolling off, but the central banks have still got their head in their sand, and they really don't want to fuck up again, basically, on inflation, because they fucked up by helping ignite it, which they didn't need to. There was plenty of government stimulus going along, closed borders, supply chain problems, plenty of those things to trigger inflation. We certainly didn't need those ridiculous monetary free money policies that they did, and the extent of the QE policies. That was a fuck up that will be not viewed kindly for history. So they don't want to fuck up again in terms of taking their foot off raising rates, because first of all, they want to get them back to a normal level. Second of all, they don't want to have egg on their face with inflation. In terms of reining in inflation, you're not going to get governments like doing things like raising tax to get back the money that they printed through modern monetary theory, which was the idea. That's just not going to happen, right? So there's a whole lot of reasons why I think the central banks are very much at risk of raising rates too much. The 10 years, they kind of see what's going on, and that's why they're looking so much weaker than the 2s, which is why I think the curve could invert quickly and suddenly, and then flatten, mild steepening. I think the days of actually extremely steep interest rate curves, it's almost over, I think. Anyway, now this is the curve, right? So you can see how this is the blue line is the 2s. They're the ones that do the hard work, right? And the curve, you can see it's kind of flat to inverted up here, inverted because of the 10s that have come off. Now the line that I've drawn here, it's in a bit of a funny place, because if you look at this on a log scale, that's we're exactly where things were meant to be. That's kind of it, right? So I don't think there's a lot of scope for rates to keep on spiking higher. We've seen that in terms of them coming off. And I think there is scope for this, for that, for that, and for that kind of action, which is a curve steepening. But I do think as it comes off, the 10 years are going to lead the way, and it's going to do a little bit more inversion as the 10s drag the curve down. Let me just take the 10 years off for a bit. This is just the 2s, and you can see what I mean about the 10 years looking far more vulnerable than the 2s. Hang on, let's go back to this line. We'll go back to it daily. These 2s, they've got like a fair bit of support there, right? They've got a bit more activity here. There is still very much the risk of this happening, right? Big move up, past the parcel, dropping down very suddenly. There still is very much that risk, but when I look at it, I just don't get the feeling that it's the same weakness. I just get the vibe that it's the same weakness as the 10s, the susceptibility. Let's look at the 10s again. Yeah. See, the 10s, that's all like just a blank sheet of paper, just a whooshka, like one direction, bang, right? Then it's past the parcel, shooting down. The 10s did no work in there, right? There was no contention, should we say, about the price. In the 2 years, there was a fair bit of contention there, right? So that means that was resistance, which then becomes support. So that's why I think the 2 years, they could struggle to come down as quickly as the 10s. There's still this, no questions asked, is where the price is going. questions asked, right? And that's what causes the contention in the price. So that's the 2s and the 10s. So I'm more wary of the. So I think that the rates have gone to really where they needed to be on kind of every front. And again, the 2s, you can see this, like, you know, that line there, that's 2018. And of course, 2018, when they went there, what happened? 20% correction in the stock market. What have we had? 20% correction in the stock market. It's like Groundhog Day, right? Go back to one of the videos like ages ago, right? Back here, right, when I was kind of short the 2 years. And that's exactly what I was saying. I said it's going to go to there, we're going to see 20%. That's what happened. It's not rocket science. There's patience, but it's not rocket science. Look, that's pretty much it. I won't go into the Aussie. But, you know, I guess the short version of it all is the equity markets have done their hard work. You know, they've done their hard work. They are neutral to bullish. To see them go down, we're going to need to see another shock. That's the equity markets. The Russell, the Dow, the Nasdaq, the S&P, our market. That's the same thing. Commodity markets, we've seen a lot of them turning, and I think they've got a long way to go. You know, whether it's gold, whether it's my little mate, coffee, wherever coffee is, right? Whether like copper, if I can spell it properly, copper, right? Whether it's oil, I won't go into that one. Let's have a look at like some random ones like wheat, wheat futures. See how that's turned. Where's it gone? Right, there we go. See that? Shoot up, pass the parcel, rocket down, right? Zinc. Look at zinc. Where's zinc futures? Haven't had a look at zinc for a while. Zinc futures. Yeah. Apart from that spike there, right? That's had a big correction, big strong move up, boom, boom, savage move down. Iron ore. I don't know if I get iron ore on this thing. Iron ore. Let's see what iron ore futures are like. Oh, volatile as. Well, they've kind of tanked like a while ago. You can tell I don't trade that one. But a lot of those, commodities have come off, but not all of them. I think there's more to go. So I think there's that further commodity weakness, which is then going to feed through to help lower inflation. But I think the commodities and the 10-year bonds are the smart end of the spectrum, and they're going to drive those 10-year yields lower, and the curve could have a bit more inversion to go before the 2 years and the Fed catch up. So that's pretty much it. So equities neutral to positive unless there's a shock. Commodities, mostly, well, a lot of them rolled over, further to go. Bonds, yields have peaked. Curve, I think, will invert more before flattening with a little bit of steepening coming in. And the last one I should always look at is shitcoin, because it is such a joke. Is the funny one, right? Because it's done the classic, like, you know, this is the same thing, right? As I said, it shot up, right? It's playing past the parcel, right? Against, you know, you can see the neckline was in there, you know, and then when it broke it was down pretty quickly, and I think it's got more to go down to this like 12,000 or 11,000 kind of mark. If you do a little bit of a Fibbo extension from there to that point, right, you get, just there, where's that, 13,000, something like that. If you look at it on those, on the dings on the dongs, right, all right? That's where it's going to. Look at that. That's the exact breakout point, isn't it? All right. So that's a 1-to-1. There to there to there to there. It's a 1-to-1. And that's, I guess that's something I've got my mind on, where I think that could lead to another leg down in equities, just on the risk on, risk off kind of thing. But you can see here, it's going to have Bitcoin's going to have a real struggle around 28. It could get there, maybe like 26 at the first stop. But then I think it's looking very sad. Boom, 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 shitting itself. I say with much joy. Anyway, look, that's pretty much it. That's a bit of a long one because I haven't done it for a while. So at the moment, I'm basically square equities. Like, I don't have any futures on. I've got my core position, which I don't really trade on. That's a set and forget. I'm short copper, oil, coffee, gold. The Aussie, I'm a little bit long the Aussie. Rates, I've got some building some steepness on, but they're pretty selected. They're like, in the Aussie curve, for example, more so than the US. But I do have some steepness on in the US that I've been just building. Anyway, look, that's about it. Have a good one. We'll catch you later. Ciao.